This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Real Money helps you think through ideas for investing and trading stocks. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
Market sell-off. The three major indexes have their worst day since November 7th.
Losing luster, gold prices see their biggest one-day drop since 1980.
And adding to the concern on Wall Street, a tragedy today in Boston. This is Nightly Business Report for Monday, April 15th. Good evening, everyone. I'm Susie Garrett.
And I'm Bill Griffith, in for Tyler Matheson, who is off this week.
Great to have you here, Bill.
It's great to be here.
What a tough day in the markets on many levels.
Yeah, a lot of drama today, this Monday, Susie. A dramatic reversal of fortune on Wall Street. Stocks falling sharply with all 30 Dow components in the red. Commodity prices also hit hard following a new report showing weaker than expected economic growth in China and a slower rate of manufacturing in New York State this month. Crude oil, gold, silver, copper, I mean, you name it, it was sharply lower on this day, dragging down shares of energy, mining, transports, housing, other stocks as well, and adding to the jitters on Wall Street, two explosions at the finish line of today's Boston Marathon, which killed at least two and injured many more. The Dow closed near its lows of the session, with volatility turning sharply higher in the final hour of trade. The Dow finished 266 points lower at 14,599. The Nasdaq hit even harder, down 78 points. The S&P down by 36. Both of those indexes falling by more than 2%. Bob Pisani has more from the floor of the New York Stock Exchange.
It was an ugly day for stocks, down on concerns about slower global growth. But an ugly day for the markets got uglier just before 3 p.m. Eastern Time when word came of two explosions at the Boston Marathon. The Dow, already down 165 points, quickly lost another 50 points, then closed at the lows for the day, down 1.9%, the worst one-day drop since November of last year. The VIX, or Volatility Index, also known as the Fear Index, also jumped and ended the day up over 40%. Its biggest one-day gain in more than 1.5 years. The day didn't start out much better. Gold and other commodities dropped big at the open, gold in particular down 10%, its worst one-day decline in 30 years. Other commodity stocks like ArcelorMittal, Rio Tinto, or Cliffs Natural Resources were also weak. Defensive names like Walmart, Campbell's, and Kimberly-Clark were also down but fared better. The main catalyst for the sell-off was concerns about slower global growth. China, for example, reported GDP for the first quarter that was below expectations. Now, with Europe in a recession and the U.S. posting weak economic data in March, traders are now wondering, where's the growth going to come from? For the Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Well, as Bob just mentioned, the price of gold plunged today, recording its second worst one-day percentage loss ever and closing below $1,400 an ounce for the first time in more than 2 years. Today was also the first time ever that the Dow and the price of spot gold both recorded triple-digit losses. So why the sell-off? And what may be next for the precious metal? Jackie DeAngelis has our report.
Another massive sell-off in the gold market today, but what's fueling the furious rotation out of bullion? Several factors are at play, including the continued strength in the equity markets. As investors look to move money into riskier assets, gold has lost its luster. But gold is also an inflation hedge, and as long as the Fed continues with its stimulus programs, investors believe that inflation is likely to remain in check.
People thought that the price of gold was a good hedge against stock market moves. And they forgot that the price of gold really is an inflationary hedge. And you buy gold to preserve purchasing power. Well, we're not seeing the signs of inflation because Commodity prices have not risen. Interest rates have remained low, so the cost of commodities have not really gone up.
But there's more to the story. Part of bullion's breakdown is due to the recent strength in the U.S. dollar.
Dollar strength impacts gold because if the dollar is strong, it becomes very expensive for people who do not have dollars to buy gold.
Meantime, troubles in Europe are weighing on the precious metal as well. It's believed that the tiny island nation of Cyprus may need to sell some gold to help cover its deficit. While analysts don't feel that a sale by Cyprus would have a huge impact on the overall market, they do worry that it sets a precedent for other troubled countries.
Still, some analysts believe that the sell-off is overdone and that gold will rebound. The thought is that the pile-on selling doesn't last.
Chances are that it will go up and down for a few weeks and then stabilize, and the buyers will then step in.
And while some investors are worried about how the decline in gold might impact their pension plans or 401ks, it usually tends to be a small percentage of a diversified portfolio. The recent declines might likely be balanced out by gains in equities. And there's even a silver lining. For those in the market to buy the commodity itself or gold jewelry, this could be the time to jump in. For Nightly Business Report, I'm Jackie DeAngelis.
That tumble in gold prices also prompted a rare retraction from Bill Gross. He's the founder and co-chief investment officer of PIMCO, the world's largest bond fund. At a Barron's magazine event last month, Gross called gold a decent hedge against inflation and predicted prices wouldn't move much unless real interest rates declined further or inflation expectations rose higher. Well, neither happened. And today, Gross tweeted this, quote, "Okay, so I made a bad call at the Barron's roundtable. I would still buy gold here. World reflating," end quote.
All right, joining us now to make sense, maybe, of today's big sell-off in both commodities and in stocks, we're pleased to welcome Nick Kolitz, the Chief Market Strategist at Convergence. Nick, good to see you. Thanks for joining us.
Thank you.
You think there's a big dramatic turn in investor psychology for those investments right now, don't you?
I do. Let's start with gold, for example. Gold for many years, as you point out, has been a major inflation hedge. However, with the threats of many central banks in Europe having to sell a bit of their gold holding to fund their own restructurings, I think investors are very worried about a lot of supply coming to the market. Cyprus is just a teeny bit of it. You have areas like Portugal, Spain, France, even Italy that have tens of thousands of tons of gold in their vaults. And any part of that comes out, there's going to be a lot of supply.
Nick, a lot of investors tonight are scratching their heads and saying, what happened? All these past couple of weeks and months, there have been new records on Wall Street and all the stock averages, and they've been told that the economy is doing great. So what's changed?
You know, what's changed is that we got a little bit complacent. I think everybody looks at the market over the past couple of weeks and says, well, you know, we weren't really fully gauging what might happen if the economy slows down or doesn't speed up. And I think today was really just the reckoning for a lot of those concerns.
You know, we've been in a period where people have been expecting what they call a correction, maybe as much as a 10% pullback from whatever highs we've been hitting here lately. Do you think this is the beginning of that correction right now?
I think we're certainly seeing a bit of a correction. I don't know how much more it has to go, however, because fundamentally we still have very low interest rates, and U.S. corporations are still posting basically record high levels of earnings against the backdrop of a very weak global economy. I think the concern is that if we get a big downdraft from either whatever happens out of Boston or some other macro factor, that's the real risk factor. But as far as the fundamentals near term, very strong earnings, very low interest rates, hard to argue against stocks with that backdrop.
Nick, you just mentioned the Boston Marathon incident. We're still getting bits of information. We don't have the complete story on that tragedy, but events like that do impact investor psychology. How much of an impact?
Yeah, that's exactly right, Susie. You know, really two factors to focus on here. First, what effect does it have on consumer confidence? Because these kinds of events obviously scare people, and rightly so. So the first question is, how does it affect consumer spending? How does it affect consumer psychology? You know, the broader issue is a bit more nebulous right now, which is what are the geopolitical ramifications of the event? You know, we've had examples over the past 20 years of, you know, horrible tragedies like this, Oklahoma City or even 9/11. Some of them have very profound impacts on geopolitical balance and the economy, and some don't have quite a bit as much, and we just don't know which one of these it is yet.
Since the lows of last year, Nick, there's been a mindset among investors to buy the dips, as we say. As the market comes lower, they step in and see an opportunity to buy. Now, we've had a pretty good sell-off here the last couple of days. And so far, nobody's stepping in. Do you think they will, or should they at this point?
You know, I think in terms of thinking about how to invest and over what time frame you are investing, if you're investing for a 3 or 5 year horizon or longer, then ultimately you focus on the fact that corporate earnings are very strong despite a very weak global economy, and buying makes sense. If you're a trader, or if you have seen the action over the past couple of days and it scares you and you think you're overexposed to equities, then the opposite advice is true. It probably is time to take some off the table because you're overexposed and your risk comfort is obviously out of whack with reality.
Nick, you have a standard asset allocation, 60% stocks, 40% fixed income, and you really don't change it when the stocks are going up or the stocks are going down. So what is your advice to investors? What should they do right now? Just sit tight?
Yeah, 60-40 is a very solid split. It maximizes return and minimizes volatility. I think if you have seen the action over the past couple of days and you're comfortable with your portfolio, it makes sense to sit pat. My concern is that a lot of your viewers probably are sitting on some pretty sizable gains over the past couple of years. Maybe that 60-40 isn't quite where it should be. Maybe it's 80-20. For those investors, for those viewers, I would recommend paring back on equities because you're overexposed, even though the stock market's obviously done well.
Nick Kola is the Chief Market Strategist at ConvergeX. Thanks for joining us.
Thank you.
Well, shares of Sprint were as good as gold today, shooting up nearly 14%, easily making it the biggest gainer in the S&P 500. Now, the reason? The Dish Network is offering to buy Sprint for $25 billion, and this is the second takeover bid for the wireless phone carrier. Julia Borston has more.
Wireless provider Sprint is at the center of a takeover battle. Today, satellite TV company Dish offering to buy the company and trump the proposal from Japan's SoftBank, sending Sprint shares soaring. Dish saying its offer is a, quote, superior alternative to SoftBank's proposal, a 13% premium to SoftBank's $20 billion bid to buy 70% of Sprint. Dish chairman Charles Ergen saying, quote, a transformative Dish-Sprint merger will create the only company that can offer customers a convenient, fully integrated nationwide bundle of in- and out-of-home video, broadband, and voice services. Ergen is trying to push Dish from the slower-growing pay TV business into the faster-growing wireless industry and to break the mold of his pay TV rivals like DirecTV and Comcast by offering mobile phone service. Dish's bid comes at a time of consolidation in the wireless industry and growth in the broadband business. Ergen wants to offer a wireless alternative to broadband by making this deal with Sprint, which he says is well-positioned to deliver high-speed Wi-Fi in dense areas. But Dish shares dropped more than 2% today on the offer, a bold move in a competitive landscape that raised concerns for some analysts.
On the one hand, capital. Dish would be spending everything they have in order to acquire Sprint. They don't then have the capital to invest in Sprint and extract all of the value from the spectrum that they will have amassed. The second concern is operating skill. They don't have a track record in wireless.
Now the ball is in Sprint's court. If it decides Dish's bid beats SoftBank's, then SoftBank could make a counteroffer. And if Dish snags Sprint, it'll push all the pay TV providers to find new ways to distinguish their bundles. For Nightly Business Report, I'm Julia Borston.
Also from the wireless phone industry today, the board at Metro PCS, this is the nation's 5th largest carrier, has approved an amended takeover bid from rival T-Mobile and is urging shareholders to okay the deal as well.
Coming up, the one big bank earnings report you need to watch this week. But first, a look at how the international markets closed today.
Despite the huge sell-off in the stock market today, there were still some bright spots. We begin our market focus with a look at a $13.5 billion deal in medical technology. Thermo Fisher Scientific, a maker of lab equipment, is buying Life Technologies, which makes gene sequencing machines. Both companies touched all-time highs at the open. Thermo Fisher finished down more than 1% to $78.58, but Life Technologies jumped 7.5% to $73 a share. GlaxoSmithKline also touched an all-time high after the Food and Drug Administration gave a better-than-expected review of an experimental treatment for lung disease. This could open the way for approval when the new treatment will be reviewed by an FDA panel on Wednesday. GSK gained more than 1.5% to $49 a share.
Well, as the media space reshapes itself, BTIG Research began coverage of Netflix with a $250 per share target price, noting that the service is being offered as part of internet bundles as well as by cable providers. Rich Greenfield, that analyst, said that Netflix has what he called an improving price-value relationship. Netflix shares gained about 2% on an otherwise down day today. Energy, though, was the worst performing sector today as oil dropped below $89 a barrel. Anadarko dropped almost 6%. The blue chip oil majors, Chevron, ExxonMobil, they were near the bottom of the Dow, each down about 3% in today's trade.
Solid quarterly earnings from Charles Schwab today, but they missed analyst estimates by a penny a share. That's partly because the firm waived fees on money market funds, so investors did not receive negative returns due to low interest rates. Schwab shares tumbled almost 4% to $16 a share.
And on a day that saw shares of nearly every bank or financial firm lower, Citigroup shares bucked that trend, rising a fraction higher after beating analyst estimates last quarter, chalking up a profit of $4 billion by pulling in more revenue in its investment banking unit and setting aside less funds for bad loans.
Now that Citigroup has reported its latest quarterly results, joining Wells Fargo and JP Morgan, investors are waiting to hear from one more huge bank, and that one may reveal more about the health of the banking sector than any other lender. Kayla Tausche tells us which bank and why as we begin a new series this week, Earnings Spotlight.
For Bank of America, it's been a year of reckoning. Legacy lawsuits put behind it, the stock doubling. And after years of pushback from regulators, capital is finally being returned to shareholders. Earlier this month, B of A took advantage of the good news with an ad campaign, reconnecting with customers now that it's had a facelift. But its biggest test comes Wednesday when the nation's second largest bank reports earnings. Sturdy rivals JP Morgan and Wells Fargo reported last week, showing some first quarter weakness. The reason? The mortgage boom going quiet. Homeowners once rushing to refinance at low rates, boosting banks' loan volume and canceling out thin margins. Now it's clear that's a thing of the past. Wednesday will show how much B of A had at stake there. Then there's expenses. Deep into $8 billion of cost cuts, thousands of layoffs. Analyst Jeff Hart is looking for progress in one specific area.
The big thing for Bank of America is how quickly can they get the problem loan mortgage servicing portfolio down, because that's where a lot of the expense saves come into play, and that's an important part of taking Bank of America from where it is now, which is not a particularly efficient bank, to where I think it should be and will be as one of the more efficient banks in the country.
Hart says the bank should benefit from more companies selling stock and bonds in the first quarter. Investment banking, a surprise positive for peers like Citigroup and Wells Fargo, with franchises far less developed than B of A's. Nomura analyst Glenn Shore says investor expectations for Wednesday's results are high, a welcome change for a bank with a troubled past.
Look, I think Bank of America has been executing on their plan for a good year now, coming off bottom, improving their capital ratios, taking out costs where they need to, and the investment bank is actually performing pretty well.
The question, whether the momentum can continue. For Nightly Business Report, I'm Kayla Tausche.
Tomorrow, our Earnings Spotlight series continues when we highlight the one tech report to watch. But still ahead on the program tonight, rising home prices, strong demand, even bidding wars. Is this what a healthy housing recovery looks like? But first, let's take another look at commodities. Shares of home builders got hammered today, along with the rest of the market, after home builder sentiment fell in April for the third month in a row. The NAHB Wells Fargo Housing Market Index slid to a reading of 42, down from 44 last month. The index also fell below economists' expectations. Now, despite the housing recovery, builders say they're worried about getting hold of construction loans and rising costs for materials. But our next guest is shrugging off today's downbeat report. He says the housing recovery remains robust. Here to tell us why, Jed Kolko. He's chief economist at Trulia. This is a real estate website. So we are getting mixed reports. Some places home prices are up, and a lot of demand. Other markets just the opposite. Is this a regional housing recovery?
We're seeing the recovery strongest in two types of markets. Markets that have strong job growth, like the San Francisco Bay Area, Seattle, Denver. They're seeing strong price increases because there's strong job growth to support it. But we're also seeing really strong price increases in places that were hit hard in the housing bust. Places that saw big price declines, like Phoenix and Las Vegas and Detroit, are now seeing a big rebound today.
I was in Los Angeles over the weekend, and the lead story of the Los Angeles Times on Sunday was a bubble market, as they were describing it there, where there are auctions happening once again for homes that are being sold there, mainly because of a dearth of supply. They're not building homes as fast as they used to out there.
That's right. Inventory is very tight, especially in California, but across the country. There are a few reasons for that. First of all, prices bottomed about a year ago nationally, and nobody wants to sell at the bottom, but everyone wants to buy at the bottom. So people who have the choice may be holding off and waiting to sell till prices are higher. There are still people who are underwater, and construction levels still are low. Even though they're up from where they were at the worst point of the bust, construction still is way below normal levels, and so it's not keeping up with the increase in the rate of household formation.
And Jed, we know that there are still a lot of homes in the foreclosure process, and at some point, they're going to be put on the market. So what is that going to do to demand home prices? What happens?
That foreclosure backlog, the shadow inventory, is actually now pretty localized. In places like Florida, New York, New Jersey, and Illinois, there's a large shadow inventory of foreclosed homes still to come onto the market, but not in most of the rest of the country. It's really in those places where the judicial process, the legal process, means the foreclosures take very long to go through the whole process, and there's therefore a big backlog.
Interest rates, a key component in all of this, and the Fed has a lot to say about that. By keeping long rates low, mortgage rates are still near record lows right now. How much longer do you think that lasts?
Mortgage rates are still near historic lows. Most of us expect rates to go up, maybe 6 or 7/10 of a point between now and a year from now. The biggest effect that'll have is on refinancing. It'll have a smaller effect on home purchases, though, because so many factors go into the decision about whether to buy or to rent, and prices are still very low relative to rents. Even if rates went up 2 full points, it would still be cheaper to buy than to rent in most of the country.
All right, so here's the question that a lot of people are stuck with. If you're a buyer, do you buy now while the prices are still low, as you say? And if you're a seller, do you hold out because maybe prices are going to go up? Is this a buyer or seller's market?
It's definitely a seller's market. Inventory is very tight, and now that the economy is recovering, there are more buyers who are interested and want to take advantage of today's low rates. The challenge for buyers is even if they can qualify for a mortgage and have enough for down payment, there's not much to choose from. So buyers who want to jump in before prices and probably mortgage rates rise further might find that they have little to choose from and might have to settle.
Lenders, we are told, have still been pretty tight. I mean, they're not nearly as loose as they were before the financial debacles of 2008 and 9. Are they lending as much as they could be right now for people looking to buy a home?
Right now, the average credit score of people who are getting a mortgage is still very high. The average down payment is still higher than it typically is. That reflects the fact that lending is still tight. When people ask, is there a bubble going on? One reason why there's not is that it's very hard for people to borrow more than they can afford. Those tight lending standards are one of the things that's preventing us from getting back into bubble territory. We'll have to see whether some of these new mortgage rules that are designed to outlaw or make less common the toxic lending that we saw during the bubble has a big impact on mortgage credit.
Oh, a lot to think about. Jed, thank you so much for coming by. We really appreciate it.
Thanks for having me.
Jed Kolko, he's the chief economist at Trulia. So it's a different market depending on where you live.
What's the old saying? All real estate is local. And we can talk all we want about national trends in real estate. I think it's clear that the housing market is recovering, but there are so many factors that go into it, as he was pointing out. You know, certain regions that were the hardest hit may bounce back quicker than those that have been steady through this whole process.
But those auctions and bidding wars make it really tough for people who really do want to buy now.
I went through that process in Los Angeles years ago. That does not bode well if that's the case here. Finally tonight, Susie, just a friendly reminder, it is tax day. A new study from a group called the National Taxpayer Advocate, which is actually part of the IRS, uses confidential tax data to determine who gets audited for being most likely to fudge on their returns. Some of the hotbed areas for tax cheats: Los Angeles, San Francisco, Houston, Atlanta, and Washington, D.C. And Susie, some of the top small businesses that raise red flags are construction companies, real estate rental firms, because they tend to write off so much. So there's so much going on there. We have to keep an eye on those tax sheets. But
first, you got to file your taxes.
Exactly. And hurry up if you haven't done that already. Right?
You got till midnight. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for watching.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Options Profits helps educate beginning and seasoned options traders. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. A major sell-off in the markets today, driven by a steep drop in the prices of oil and gold, following weaker than expected economic growth in China and a slowdown in manufacturing in New York State. Gold had its worst one-day percentage loss in 33 years. Adding to the jitters on Wall Street, two explosions at the finish line of today's Boston Marathon, which killed at least 2 and injured dozens more. On Wall Street, the Dow tumbled 266 points, closing at 14,599. The Nasdaq was lower by 78 points and the S&P down by 36, both falling more than 2%. Home builder sentiment fell in April for the third month in a row, with builders worried about rising costs for materials. And tomorrow we have a special report from China on how Ford's strategy there is paying off. Tune in to Nightly Business Report right here on your public television station.